Well, hello, ladies and gentlemen. My name is Mark Dunn, and I'm the editor of Portfolio Institutional, a magazine that looks at the investment side of pensions, insurance, and foundations. Welcome to this virtual roundtable discussion. This is one of a whole series that such events that we've held since the first lockdown was announced in March, which is all about, 8 months ago now. This particular chapter in our series, looking at the impacts and the issues affecting institutional investors, is going to focus on local government pension scheme pooling. Now, in 2015, or 5 years ago, the then Chancellor of the Exchequer, George Osborne, announced he was going to reform local government pensions. He was very interested in getting them to use the huge pots of capital they had at their disposal, which at the time, I believe, was somewhere in the region of £260 billion combined. And he wanted to use that to benefit society through trying to encourage more investments in the upgrading and repairing of the UK's infrastructure. The revolution, of course, was also designed to directly benefit savers as well through cutting their costs. And now to do this, all 89 local authority pension schemes in England and Wales would have to join one of 6 pools that were to be created. Well, it turned out 6 wasn't enough, so we've got 8. And I'm very pleased to say we've got 4 of those pools on our panel today. And before we get down to exactly how the first 5 years have been and what's been happening with pooling, it's always good to know exactly who it is that we're listening to, and who better to introduce the panel than the panel themselves. I'm going to start in my top corner of my screen here, and that person is Laura. So Laura.
Good morning. So Laura Chappell, CEO of the Brunel Pensions Partnership. So I have been in role now for, oh golly, just over, coming up for 10 months formally, I think, having been with Brunel previously. Interestingly enough, the first 3 months were in the office. The rest of it's been on lockdown.
Yeah. Got you. And Michael.
Thanks, Mark. Good morning, everybody. Mike Weston, Chief Exec of LGPS Central. So we are the pool that represents 8 partner funds, local authorities across the Midlands, from, if I get my geography right, Cheshire in the west and Leicestershire in the east. So apologies to my colleagues if I've got my geography slightly wrong. But amongst those pools, part of your 260 billion of assets, Mark, 45 billion-ish belong to the 8 partner funds of LGPS Central. And that means between them, and the schemes between them, have around about 1 million members. Same again for dependents of those members. And they are supported by 2,000 odd individual employers across the region. So it's a reasonably sizable endeavour. We're based in Wolverhampton, so within our central pool region, and have just over 60 people now running the operation. And I joined LGPS Central in March 2019. So unlike Laura, so far I've had the majority of my time in the office rather than out with COVID. So good morning, everybody.
Thank you, Mike. And Rachel.
Morning, everybody. So Rachel Elwell, I'm the CEO at Border to Coast. We're based in Leeds. We are not dissimilar size to Central, so about 1 million members, 2,500 participating employers, and depending on what's happening with markets, somewhere between 45 and 50 billion of assets across the pool, although obviously not all of that has yet actually been physically pooled into Border to Coast. And I have been with Border to Coast for coming up to 3 years.
And last but not least, and only because you're at the end of my screen here, Kevin.
Oh, good morning. Hi, my name's Kevin McDonald. I'm the interim director of the Access Support Unit. So Access is a pool based on 11 authorities. As Mike and Rachel have already indicated, our size is broadly similar to those of Central and Borders to Coast. So at the close of the last financial year, the combined assets of all of those authorities was around about 45 billion. half of which we now have under pool governance. And the location of access is predominantly in the east of England and the southeast. I've been with the Access Support Unit since August last year, and prior to that I've been 20 years with Essex's pension fund.
Gotcha. Okay, guys, thank you very much for that. We have a lot of ground to cover in the next hour. So a very good place to start, actually. We go straight from the top. 5 years ago, George Osborne, he wanted you guys formed and created. So how have the first 5 years been? Laura, if you could just give us a flavour of what's been happening with you guys.
Wow, I think it's fair to say busy. I think probably all of us at Brunel signed up for a startup firm knowing that we were going to be very committed to doing what we needed to do in the timescale that we needed to do it. And I'm pleased to say we are actually on track, which is great. So our total partnership at the moment is about 33 billion. So we're a little bit smaller than the other pools. And to date, we have transitioned about 21.5 billion. So that's about 65%. So we're getting closer and closer to the end now. So I think for us, the proof is in the transition. Actually, we've sped through that. We've kept within our costs, which is great. We've invested in new assets, which we'll talk a little bit more later on, and we're getting an awful lot of intangible benefit from pooling as well. So I think for us, I'd probably say it's been busy, and I think all of us work in asset management because we like change and we know it's never going to stay static. I think the last year has probably given us more to think about than we actually wanted to. At the moment, you know, we've got COVID on the table. We've got Brexit, we're looking at the US election and wondering what the outcome of that's going to be as well. So I think for us, yeah, the answer is probably busy.
And Rachel, is that what you guys are finding?
Yes, absolutely. I mean, just to give some context, it was 5 years since George Osborne said you shall pool, but it took a couple of years, funnily enough, for everybody to work out how to do that. So we went live in July 2018, and since then we've been working very closely with our partner funds to develop the capabilities they need. And I think just building on what Laura said about managing change, that coincided with a huge review of strategy for well, the LGPS in general, but our partner funds looking to move in much more into private markets than where they were previously. So maybe some of the plans that had been identified at the beginning before the pool actually was established, we had to work closely with our partner funds to see how they should evolve, because actually what the partner funds was needing was changing at the same time as we were building, which is also challenging. But I think it's really important that the pool is set up to help the partner funds to implement their strategy. Therefore, we need to be able to be flexible to meet their needs. And that is challenging, because I think anyone who works in asset management knows that you don't build things overnight. It's complex, regulatory, impact on markets is important. So really takes a lot of planning and a lot of talking with each other to make sure that what's being built is what is needed.
Thank you, Rachel. Now, Kevin, you joined and you took over a little over a year ago, and what a year that's been. So what did you find when you walked in the first time?
Well, I've been working with other access authorities in the formation of the pool, so I wasn't migrating into an area that I was unfamiliar with. But I think what all of us would acknowledge is that pooling and a set of events that the Chancellor's July 2015 budget heralded, that has fundamentally altered how we view investment and how the LGPS views investment, because we're either talking about assets that have been pooled already, transitioning assets or migrating in the process of it, or how we're going to approach what we have yet to pool. So the lens has fundamentally shifted, and pooling is responsible for that. What we found in access, or the access authorities as they came together, was that there were a number of commonalities. I think the LGPS has always been a relatively well-connected community and well enabled to collaborate. But obviously pooling has sort of brought hubs and magnetised the way in which people do and have to collaborate. In Access, we found that there were some threads and commonalities which eased some of the initial decisions on how we would approach it. So, for example, unlike a number of other colleagues' pools, there was no legacy of internal management within Access. So all of those authorities had traditionally employed external managers. That was one thing that we were able to take forward as a position that we'd like to build upon. And what we also found was that whilst within the alternative sphere, and I think that is a challenge for us going forward, there's quite a degree of diversity in how those funds have historically invested. For listed assets, there was a lot of overlap. So when we first looked at the asset allocations and the way those portfolios were being deployed, almost 3/4 of the Access assets resided with a dozen investment firms. So by the time we started to then put an operator in place, and it was Access's choice to procure rather than build an operator, our operator Link was looking at some areas of commonality as how they established the first part of the ACS landscape.
Okay, that's right, Kevin. And Mike, yourself, you were no stranger to local government pension investing when you took over Central. So what have been your priority? How have things been for you?
I would echo what what all my colleagues have said. Busy and complex. You're right. I've been investment manager for a number of LGPS for a while in previous existences, so I had some understanding of how the whole sector worked. But it is much more complicated, as Rachel said. So I think if I could sum up my time as the others have done, is it's been very busy. We've achieved an awful lot, but there's still an awful lot to achieve. I think we're probably about halfway through the journey.
Okay.
And I think if you look at us, if you look at all of pooling, I think we could probably all say that the initial business plans that were put together in that pre-launch period were a bit optimistic. Because certainly for our own, if you look at the original business plan, all the assets would have transitioned by now. We've been into business as usual, and actually we're only halfway through. And that's not because there's any desire to go slow. It's purely because when you actually get things up and running, it's more complicated than anybody can imagine. And with us, with 8 partner funds, again, as Rachel said, we need to make sure that all 8 partner funds are happy and content and are all moving forward at the same speed. We're an FCA regulated business, so we have FCA regulatory restrictions and requirements on us, which is something completely new for our local government colleagues in the pool. And we have to balance the whole TECL regulation that impact very much on them with the FCA regulations that impact very much on myself and my board colleagues as managers of the asset management business. So the difference between theory and practice has been large, but we are making good progress in terms of asset transitions, launching new funds. We were very pleased to get our first AAF Type 2 report done, which is common practice for the external asset management industry, but is a big thing for a new asset manager to go through and demonstrate that controls all the processes are working as you'd expect them to, and gives an external endorsement of the quality of the governance of the pool, which is something that is, as I say, taken as read for external asset managers. That's had to be built from scratch within a new pool company. So it's been hard work, very busy, very challenging, and it will be similar going forwards, but the end prize is still as great as it ever was. So we're halfway there with half to do.
Okay. I mentioned at the top there that one of the main reasons behind this was because the government is faced with a great big bill to cover the upgrading of the infrastructure, and of course with the huge pools of capital you guys are controlling, that this is one way of solving that. And you also mentioned there, Mike, about the gap between theory and practice in setting up these pools. So have any of you actually been doing what the government wanted originally, which is not investing in UK infrastructure? Rachel, can we start with you? Is this something that's you're doing at the moment?
I think just to maybe build on where the government got to with that, I think there was very quickly a clarification of maybe what was said originally, that infrastructure was a good investment for a pension scheme, but the LGPS is not a sovereign wealth fund. So absolutely, infrastructure is a good investment, but it's important that what we're investing in is meeting the needs of the pension funds. So yes, we do invest in UK infrastructure, but we also invest in global infrastructure, and that's part of the reprioritisation we did very quickly when we understood with our partner funds that private markets was a real area of growing focus. So we are investing about £1.5 billion a year into private markets. About half of that, just over half of that, is into infrastructure, and absolutely elements of that are into the UK, but it's not about solving any funding gaps that the UK government might have.
Right. Okay. You said that you are actually investing in UK infrastructure. What sort of things is it you're investing? Is it roads, is it bridges, is it communication networks?
It's things like renewable energy plants, and the ways of, and there's so much that's needed in the UK, but absolutely globally, it's all of the things that you've just said, Mark.
Okay, gotcha. I saw you nodding along there, Laura. You guys also, you've got interest?
Yeah, I think what Rachel said is absolutely right. Whatever we invest in has to generate performance and make sense financially for our partner funds at the end of the day. And yes, we have an infrastructure fund as well, but also we invest in real assets too. So, one of the things that we did just this last year is invest in a giant greenhouse project in the UK, which I think was all over the BBC if you check. It's on there. But one of the benefits of pooling actually allowed us to move really quickly on this project for our clients and get the money in the ground ASAP. And I think going forward, we're only going to see more of those. So I think, probably everybody knows that Brunel has a very strong sustainable stance to our investments. And UK infrastructure, sustainability, there's only going to be more opportunities there going forward, I think. So I think, particularly in this post-COVID world, I definitely see more coming. Yeah, we've got a very strong allocation to infrastructure, but again, we will look at it globally and not just relation into the UK, because we've got to do what's right for our clients.
And Mike, what about you? Are you seeing a good pipeline of opportunities here in terms of infrastructure?
I can echo what Laura and Rachel have said. Okay. Where we start is what assets fit the strategic asset allocation needs of our partner funds. Okay. And that's driven by their thinking about the overall environment. I was in a discussion yesterday about the outlook for inflation going forwards, and real assets like infrastructure are one of those inflation hedges. It's a real positive cash flow generator if you get the right types of assets. And as the schemes increasingly focus on cash generation to meet liabilities, these are obviously assets that fit into that kind of framework. Private markets, as I think we've said, are a complex asset class. One of the reasons there's been a focus in pooling is because, in terms of cost saving, there's get assets pooled together, and across our partner funds, there is a spectrum of involvement. So there's some that have been very much involved in the past, and some that have been less involved. So part of our role going forward is to bring everybody together into private market products that suit their all needs, from the most sophisticated right on down. And that's something we're working on. So we've got private equity up and running. Infrastructure is, we've been working in various aspects of that. There's a fund that's coming along that is sort of around about Christmas time, should be up and running.
Okay.
Also working in the private debt space and the property space. So across the whole real asset spectrum, it's an important area going forward.
Gotcha. Okay, so, and Kevin, Access, of course, has a very different model. You guys are very invested in listed assets, but I do believe that there are intentions, especially in the new year, for you to start moving into more sort of real alternative assets. I mean, can you tell me how that's going at the moment?
Yeah, I mean, I think first of all, I'd echo what's already been said. I think Rachel's point about the desirability of infrastructure. It may be understandably an ambition of those who commenced the pooling initiative that it would be UK infrastructure, but there is fundamentally the fiduciary duty that the those undertaking LGPS investment decisions need to have regard to, and so the infrastructure will doubtless have a UK footprint, but not from a UK exclusivity perspective. You're right, most of Access's activity to date has been in the listed space, but we've been working a lot this year with colleagues at B Finance to come up with solutions for how our constituent authorities can invest in a pooled way.
Okay.
A lot of them have already put liquid investment portfolios together historically, but from a pool perspective, we hope to commence implementation in the new year, and we would want to cover infrastructure, but also a real estate offer along with private debt and private equity.
Okay. Pooling, of course, as we talked there, cost was another benefit. But have any additional benefits been discovered, been delivered? Any sort of side effects? Rachel, have you seen any additional benefit come through?
I think, I really don't want to steal Laura's thunder here, because I think Brunel are particularly strong in this area, but with scale comes collective voice.
Okay.
And that collective voice could be used in a number of different ways, and maybe Laura can talk about responsible investment, which I think it's vitally important for all of us. And at Border to Coast, we've done a lot of work in that area, but maybe just thinking more generally about what collective voice can bring. So, for example, I've just joined the Investment Association Board, which is the trade body for the asset management industry. And I think in part that's a recognition for the industry that pooling more generally, not just pooling within the LGPS, but if you think about the other initiatives that are happening with pooling, from example in defined contribution or in private pension provision, that's shifting the balance, I believe, in the UK, where maybe historically the asset management industry has been very, very strong, and the asset owners have been a bit more splintered. If you bring your pools together, you get a much louder voice and a much more sophisticated buyer, which means that the relationship between the asset management industry and the asset owners is shifting. And I really hope that will have a really good impact on the asset management industry, because if you have a strong asset owner base, you also have a strong asset management industry, because they have to be strong to be able to face off to it. So I think that has positive benefits in terms of how asset managers think about responsible investment, but also in how they develop the propositions for us to work with asset managers. And for Border to Coast, we've got a very strong internal management team, as well as working with external managers, which again I think gives us the ability to be able to work with the asset management industry very much as a peer-to-peer discussion.
And Laura?
Yeah, so building on what Rachel said, thank you, Rachel. I think collectively as pools, we are all now large institutional investors. That gives us an awful lot of buying power and quite a big voice. And in particular, we use that voice in the responsible investing space. And I think the benefits of scale have given us the ability to be able to move quickly with one voice, particularly in this kind of stewardship and activism arena, where we've got 10 clients for us that all come together, that speak with one voice and vote with one voice. So actually that gives us a lot more power in that respect. I think the other real advantage, which we will see in the future that we're not seeing yet, but it will come, is on the journey towards net zero with the portfolios. Now, that journey is going to be an awful lot easier collectively. If we're all pulling in the right direction, we're going to make significant strides more quickly than if you're a small pension fund just acting on your own. So I think the benefits of scale there are going to be enormous going forwards. And that ability, I think we've already demonstrated at Brunel the ability to be able to push the industry forward on a number of issues. RI is just one of them, but the other things, I'm not going to steal anybody else's thunder here, but I think is cost saving, and it's worth talking a little bit about the cost savings that we've made. So yes, fees have come down overall, but actually part of the work that we've all been doing on transparency has enabled us to drive those costs down. So I think, you know, there's a lot happening in this space that we could be talking more about.
Gotcha. And Kevin, we mentioned earlier about your mainly invest in listed assets. I mean, is this collective voice, this engagement, is this something you guys are actively involved in, or something maybe as you move more into the real assets you do more of?
Well, I think we at Access recognise that we are in a position where the starting point for pooling, or indeed the starting point where access authorities commenced physically migrating assets into an ACS, that was 2 years ago. And so if you build back or look to what would have been the ESG RI approaches amongst LGPS authorities at that time, they have developed and moved on since. There's a lot happening in this space. And clearly Brunel and others are leading in a number of ways on RI that are in the interests of, but also to the benefit of all of us. We're currently in the process of procuring some external RI advice. We recognise that our guidelines need a review and an update, and so we'll be going to market in order to procure advice to allow us to position what we do on RI in a way that meets the needs going forward, because be it the stewardship code, be it climate change related disclosures, these issues are coming down the line very quickly. The expectations both of and at institutional asset owners are going to increase, and rightly so. And we're attempting to be in a position to be able to meet those as well as we can.
Thank you. And Mike, what sort of additional benefits are you seeing to pooling?
So I would, so cost savings are important, transparency is important. The two I would add is investment performance. So one of the benefits of cost saving is to improve investment performance. And as my partner funds continually tell me, and is, you know, clearly the most important thing historically for investment managers is to deliver the investment performance that partner funds need to be able to meet their pension payment promises. So that's really important. And then the other thing is just simple resilience. If you're at a partner fund and you've been running your scheme with two or three individuals in a pensions department, now you've got 60 odd people running the assets for you. So there's much better inbuilt resilience and support to the pension scheme. So those are the two additional ones I'd put onto those we've already talked about.
Thanks, Mike. And here's from what we just heard there, it seems that there's a lot of collaboration between the pools, especially when it comes to this unified voice. But away from engagement, I mean, are you guys working together? Are you meeting up? Is there any sort of body or anything like that? You guys are all sitting on where you're sharing ideas. I mean, Laura, is that something you're seeing?
Yeah, so as pool CEOs, we kind of catch up fairly regularly to share ideas around, you know, what's happening. We definitely had a few good meetings at the beginning of COVID, just to compare notes on what we were all doing. But I think, you know, aside from that, there's been some good collaboration over investment, over tax savings. So I'm trying to think of fee savings. We've done collaboration on that as well. We've talked about sharing information, particularly in the private market space, more effectively when we're doing due diligence. So I think for me, there's only going to be more collaboration across pools going forward, especially as we move out of transition and into business as usual. It's harder to collaborate when you're in the middle of a transition because you're kind of keeping that close to yourself. But as we move into business as usual and just managing the portfolios, I can see that more opportunities will probably arise between all of us. And again, particularly in the responsible investing space. I mean, we've been very open and transparent about the work that we've done, and we've shared it with everybody. There's no competitive advantage to be gained here with pools. So for us, you know, it's not an intellectual property decision. This is actually about doing what's right in the world. So we've been very happy to share and collaborate across the board with the work that we've been doing there.
Okay. And Rachel, what are you getting out of this collaboration?
Well, everything that Laura's just said, but I think it can be it's really helpful as you're going through this creating pools. It's quite unusual, not been done in the UK before, so learning from each other as we go through, that's really important. Collaborating so we're looking at commissioning a piece of work to look at what can be learned from what international pools have learned. So if you look in New Zealand, Australia, Scandinavia, Netherlands, Canada, they've all gone through this over the last 15 years. So we're that sort of thing can also bring really helpful learning to us. As Laura says, if our investment teams can work together, then we can generate savings in terms of the cost of investing, but also cost savings because the scale that we bring as LGPS rather than just as the pools is even greater. There's many different ways that we can work together and are working together. Oversight of service providers. So I know that the CEOs get together regularly, but so do the COOs, our chief operating officers, so do our chief risk officers. So we're really trying to encourage the spirit of collaboration that Kevin mentioned earlier on that always existed within LGPS. That needs to be echoed into the pools because that's actually a part of how the LGPS works. We're responsible for running public money. And therefore, this is about how do we make sure that we're getting the best for taxpayers and for the members of the schemes. And that's by us sharing and making sure that we're working together.
And Kevin, is collaborating with the other pools here and the other guys as well. Does that make for a more efficient pool? Do you think, in your experience?
Well, it's happening, and it's happening in a very beneficial way. I think a number of us knew many of the people that were then going to take prominent positions in the pools, and obviously appreciating Mike is maybe relatively new to the role that he has with Central, but a number of us knew him because of his previous role in and around the Pensions Infrastructure Partnership beforehand. So bringing in people with that expertise into the pooling landscape is always going to make sense. Obviously, Access has got a different model to the other pools on this morning's call, but as an indication of the sort of collaboration, Rachel's colleague Fiona Miller has invited me into some of the Chief Operating Officer discussions that the built pools have. Now, clearly, Access, because of the way we procure an operator, we don't have the same issues or the same challenges in the same way that Chief Operating Officers would do for all of their work, but there are commonalities, and so recently some of the conversations that I've had with COO colleagues, be it tax after Brexit, where we are in terms of remote working as we enter a second lockdown. Their issues may be hard and soft in terms of investment, but they are relevant to all of us, and obviously the more we talk, the more we understand and the more we can learn. Obviously our model is one that we share with Wales, and indeed the operator that Wales use is the same as Access. So Anthony Parnell and his colleagues we're often having a conversation with them because, as Rachel indicated, there's commonality of service provider there. So the scene is set. There are good avenues for collaboration. And just a final word, I think if you drill down just below the pool or the pool company level, I think that the engagement that the constituent authorities themselves has increased because of pooling. And so on issues like McLeod or the 95k cap, appreciate they're not investment issues as such, but it's given that community a sort of a sounding board and a sort of a peer group to work through some of the challenges which I know are very demanding for colleagues at LGPS authorities at the moment.
And Mike, is engagement, is this sort of collaboration something you encourage more of?
Oh, definitely. We are really fortunate in that each of the pools was set up to serve their individual groups of partner funds. So we're not in competition with each other, which means we can collaborate. We're not restricted from that collaboration, which is great. And all the functional levels do meet up together to share that knowledge and expertise. The one additional thing I'd say is that we are, because we're all dealing with similar kinds of issues and experiencing the same kinds of challenges, as a group, we can constructively, and we do constructively talk to MHCLG about what's happening with pooling, and actively discuss and debate what the next stage is of pooling or how it moves forward, and how we can all just achieve more of those objectives that were set originally.
Gotcha. Okay, guys, thanks. And actually, it was mentioned there about lockdown, and we are living in very, very interesting times in terms of the pandemic. But some of you have actually launched new funds. You handed out mandates, selected managers. I mean, how do you go through that process with the world the way it is at the moment of picking? So would anyone like to maybe launched a fund or handed out a mandate in the past 8 months? Or like to explain to me how things are different?
I'm happy to go first, guys.
Yeah, go for it.
We've had quite a few things. Right at the beginning of lockdown, we launched investment grade credit, and just a couple of weeks ago, we launched our index linked gilt fund. They've both got well, index linked gilts is getting on for 2 billion. Investment grade credit was 2.5 billion. One of those is internally managed. One of them is externally managed. We've also appointed managers to our multi-asset credit fund and to emerging market equities. So it's been a very busy lockdown period. It's required us to really think very carefully about all the controls that we have in place. How can we make sure that we are still doing those in a virtual environment? So a lot more contingency planning, a lot more testing, being very clear. We've got the lines of communication open, getting our heads around whether doing virtual due diligence is as good as doing in-person due diligence, because we can't travel to do that. That it requires a lot more thought, and it is a lot harder, but it isn't that you can't do it. Just be very, very aware of the risks and how you are going to manage them differently when you're in lockdown.
Have you approached it, Laura?
Yeah, I would reflect Rachel's journey as well. It's harder, not least because when you're selecting managers like we're doing, you can't look them in the white of the eye face to face. You can't go to their buildings and and really get a feel for what their culture's like, and that's really important to us because we're looking at long-term partnerships here. We're not looking at hiring and firing within a couple of years. We're building something for the future. So it takes longer, I think it's fair to say. It's not doable, but it's some of those more softer aspects that it's harder to tell when you're online. So we've just launched 3 funds, and we got them done before the US election hit because we wanted to get through the transitions. Probably the right thing to do, I think, given the circumstances. But I think for us, Brunel people thrive on the creativity of coming together to discuss the pros and cons of managers and how they'll fit together, and that's harder on screen. When we opened up the office, I think there was a sigh of relief all round when people could actually come back in to start talking about these things collaboratively together. And I think that's been the biggest challenge for us. So echo Rachel's comments. It is about going more slowly and making sure that you're covering off the risk each time effectively as you go through that due diligence process and into appointing.
Gotcha. And Kevin, as we've already discussed, you guys are looking to develop your investment capabilities and your exposures. So how are you approaching this during the lockdown of assessing new managers? And
we've had an opportunity to give it some thought, and obviously liaise with our operator link on the best approach. So there was a planned pipeline for how we would approach the current year. So strictly speaking, our plans for 2021 was that we would have completed the migration of any listed asset portfolio into a pooled environment. That was the plan. You won't be surprised to hear me say that we've had to revise that slightly. We wouldn't typically launch funds in or around the end of the financial year because, from our perspective at least, given the engagement we'd require from the constituent authorities, if there's other pressures around year end and closure, we tended to step away from that. But by the time we were analysing, if you like, the COVID environment, the remote environment, it made sense to just consider if launching as we had originally planned was the right thing or whether or not it was best to pause. So what we will be doing in the coming weeks is launching a number of funds. They've been paused since earlier in the current financial year, and they'll be across global equity, UK equity and fixed income. I think, as has already been said, it's required a different approach. The remote and virtual world isn't the look and feel to how we would have done transitions in the past, but the industry has stepped up, and we've all learned what this new normal is feeling like. I absolutely value and cherish what you can get out of an office environment in terms of some of the interaction. I think Laura's point about the look and feel, the whites of the eyes, all of that makes sense. And I think when we're in a position beyond COVID to feel what the right blend of virtual and physical is, we'll be able to get, the benefits of both. We're not going to go back to where we were, but I think in practical terms, it means our plans have been delayed slightly. So what we were planning to complete in the current financial year will now push into next year.
Okay. And Mike, do you think more and more guys in your position are going to get used to selecting managers in this way if these lockdowns and the effects of the pandemic continue?
Well, part of pooling was to do investment in a different way. COVID has also forced us to do investment in a different way. So it's all part and parcel, I think. We didn't anticipate this coming along, but it is, as has been said, we've had to approach things in a different way. So it's just another challenge to overcome on the pooling journey. And we were very clear when COVID first hit that our priorities were, one, to keep all our staff safe, and two, to continue delivering the services that our partner fund expected from the business. And there was a commitment from us and a commitment from our partner funds that we would continue doing what we planned to do. So there was never any assumption that COVID would cause a delay. If we could avoid a delay, we wanted to avoid a delay. We wanted to carry on and deliver what we'd agreed as 8 partner funds and a pool company that we'd agreed that we would deliver. So we've done a corporate bond fund, selected management for emerging market debt, multi-asset credit. So that activity is going ahead. We're just doing it in a different way. And I think if you look at our launch plan pre-COVID and post-COVID, there's very little difference. So we've put all our efforts into understanding, to reacting to the conditions and adapting our process to make it work. Because we don't know how long this is going to go on. We don't know what's going to happen next. But we do know that we have assets to invest in, investment performance to deliver to our partner funds. And that's what we'll continue doing.
Gotcha. So what you're saying is every 5 years, something new, a new way of investing gets thrown at you guys. Interesting.
Every 5 years.
Yeah, I mean,
Every 6 months.
Yeah.
Gotcha. Okay. We're actually going into the last 15 minutes or so now, so we've actually got through a lot. I think one thing I'd like to ask, of course, is now you guys are all following different approaches in terms of investment. I mean, do you think there's going to be pressure from government going forward to sort of streamline your investment processes and to get you all on the same path? Do you think there's any sort of influence there? Rachel, have you got any point on that?
I think central government have been very good so far in setting some principles for local government, but respecting that it's local government's pensions, and there's a whole structure around that local government need to you know, do what's right for their partner fund. And you know, that we have 8 pools, as you've alluded to, and 5 different operating models across those 8. And those have been evolved because they were the right way to deliver for the partner funds in each of those pools. And when those pools were set up and partner funds elected which pool they wanted to join, they were doing that in sort of cognizance of what it was that they thought they wanted to build. So I'm not sure that I see pressure from central government to change that. But that's not to say, you know, over the next 15 years, who knows what will happen. We see consolidation in some of the other countries over time. So it may well be that over time there is some sort of consolidation, or maybe it's just continuing to and working more closely together. We see that there are benefits from scale, but there also comes a point where you can be too big. And I think for me, one of the really important things about local government is that idea of localism. So there are 89 separate partner funds within, or separate LGPS funds within the LGPS, because actually it's really important that the local taxpayer, through their elected members, is able to make sure that that pension fund is meeting the needs of the local area. So I think there could well be change, as we've already alluded to, but I'm not sure that there's a lot of pressure on that certainly not in the short to medium term.
What about you, Kevin? Do you see any sort of government interference in terms of streamlining investment processes?
Well, I think Rachel's hit the nail on the head, because what we're talking about is the local government pension fund, or the local government pension scheme. So with 88, 89 underlying authorities at the time of the 2015 announcement, was it a surprise that when the pools developed, there were different approaches? That wasn't a surprise because of where we came from. I think the point I'd just be clear about is that, as we've highlighted already on the call, we've got 8 pools. We're at different stages of progression. So some of us have done more, or some of us have got further into certain areas, and we're not looking at an even set of development for a variety of reasons, but there has been very, very good progress. I think my concern about your suggestion of government, I'm not sure if you said intervention or interference, but I think it's too early to be able to establish like-for-like comparisons. And I think if you can't do that, then drawing conclusions about one particular approach over another is premature. I think we're still very much in the transition phase. We're not in the BAU stage. It doesn't mean to say you can't have the collaboration, and you can't have the sharing of best practice, and you can't have initiatives around RI or shareholder engagement and so forth. That's absolutely taken as read. But I think making hard and fast conclusions about Model A or Model B, I don't think we've got enough evidence yet. And I don't think we're going to be able to have proper comparisons for some time. So it's good that we're in a position where government is engaged, and I think a lot of the government dialogue is still in listening mode. But I think that's if you look at where we came from, I think 2015, when the announcement was first made, I detected that there was sort of, I suppose, a degree of pleasant surprise in certain parts of government that the pools formed relatively quickly, because 88, 89 funds signed up knowingly, pretty much within it, by 2016. The announcement was July 2015. By 2016, everyone was allied to one of the 8 pools. So I think it wasn't a question of whether pooling happens. It very quickly became a conversation about how pooling happens, and that in part has driven different approaches. And I think we need to see those play out and then see where the evidence takes us afterwards.
Gotcha. Okay. You are right, of course, this is very early days, and of course, when it comes to comparing method A to method B, but governments do change, as we know, and their thinking changes. I mean, this was introduced by one government, and we've got 2 other governments on from that. So Mike, I mean, there's a possibility there could be some form of government intervention if they're a bit concerned about where some of the money's being invested.
I think you have to be very careful about when you talk about investment process, because as soon as you start getting into the level of government telling funds where to invest, that becomes really quite dangerous. What we had at the start of pooling is some overarching principles from MHCLG about how pooling should operate. And I think it's fair to say that from the very start, there's a spectrum of enthusiasm. There are those partner funds that are very enthusiastic about pooling, those that are less enthusiastic or more sceptical about pooling. And that spectrum still exists. And we've been, I suppose, governed in what we do by statutory guidance. And the guidance, being guidance, has been interpreted or can be interpreted differently by different people, hence some of the differences we see amongst the various models. So I think one of the things that you can do, and we might see, that doesn't impact on localism is tightening up the guidance. And our understanding is that post recent developments in the Supreme Court judgment, for example, that MHCLG recognises that the next step is probably for guidance to be replaced by regulation. And then you will see, but I don't imagine that regulation is going to be telling us where we have to invest. It's more likely to be talking about things like, should we all be FCA regulated, which we're not at the moment. If you look at the private sector, everybody's got to be FCA regulated. We've got some big asset managers in the pools, some are, some aren't. So there are various of those principles that could be, let's say, tightened up under future regulation, which comes along to replace statutory guidance. So that's what I see happening in the short term. Longer term, I mean, with Rachel, is 8 a magic number? 8 was a resultant number rather than something that was specifically said. So things will inevitably change going forward, and we've been talking about that all through this morning. So there will be changes going forward. That's inevitable. Exactly what they are, we don't know, but we will react and always fall back on those principles. We have to deliver investment performance for our clients in the best and most effective way possible.
Okay, gotcha. What about you, Laura? Anything final to add on this point before we move on that we've not already heard?
So no, I think just building on everybody else's comments, I think we'll see a natural evolution over time of what works, what doesn't work. So, internal versus external management, the RI approaches that we're using, the models that we're using, that will be a natural evolution. It's not going to be dictated by anyone, I don't think. And I, in particular, would be very worried about a government trying to dictate an investment approach. There's a reason why we were, most of us, set up as FCA regulated fund managers, which was to make sure that we were competent and safe to do the job, and being dictated to.
We lost Laura.
We've lost Laura. Yeah, I think we've lost Laura. I think. Yeah.
Oh, she's back.
Sorry. My internet just dropped off there.
Put up by the government, I think.
Yeah. Silenced.
Gotcha. We are moving into the last 5 minutes or so now. So actually, I think we could go to one final question for us all to to answer. We have talked a little bit about change and what's coming forward there, not just in the last question, but throughout the morning. If you can maybe just give us a highlight of what you see as your challenges in the next 5 years. And Mike, could we start with you?
I think, like everybody, like society as a whole, the first thing we've got to do is get through COVID and whatever COVID throws at us. And then for us, the challenge, I think, is maintaining the momentum that was established in the first couple of years when we were doing transitions of large amounts of assets into those public markets. We've already talked a bit about private markets being more illiquid, more complex, more difficult. So the transitions become more challenging as you go forward, but we need to progress those. We need to keep that momentum going. And then we need to manage the challenge of moving into the business as usual phase, which again, we've mentioned once or twice this morning. The focus of activity moves from creating all this new stuff to making sure that we're the most efficient and cost effective we can be at managing the stuff we've already got and adapting to the changes that inevitably will come along. And we've have to respect and react to the changing landscape and demographics of the LGPS as a whole, because the funds themselves are experiencing evolution and change. And as a service provider to those funds, we have to recognise them and react to them. But ultimately, the challenge for any asset manager is always going to be delivering the investment performance that our clients expect from them.
Yeah, definitely. And Rachel, what about the next 5 years for you? What are you preparing to do?
So I absolutely echo what Mike was saying about the getting through COVID, and actually not just getting through it, but also trying to make sure that the culture work that we'd been doing both within my team and between us and the partner funds actually is stronger coming through this. Really echo what Kevin was saying about not going back, but how do we go forwards? And I think from a leadership perspective, that is my single biggest challenge. But technically, we're halfway through, give or take, but we've done the easy stuff first. So actually working out how you pool some of the more complex vehicles and asset classes that we need to do, but also how we then, each of the pools has become a centre of excellence. So how are our partner funds going to make sure that we are delivering the most value that can give them? And I think the LGPS has come a huge way over the last 5 years. What does the next 5 years bring, and how much more change is needed? That's something that we're going to discover together, I hope.
Thank you, Rachel. And Kevin, what challenges are you foreseeing in the next 5 years?
Well, I think building on the solid foundations, everybody this morning has mentioned the degree of progress there's been. In a headline way, it feels as though we're generally about halfway there. It will feel within that maybe it's the low-hanging fruit that was the first port of call. So listed assets, we were able to leverage a lot of progress out of some pre-existing commonalities. The model we have, we've been pleased with. We appreciate there are J-curves in all pools. They'll come under more scrutiny in terms of cost and savings. But I understand that overall, the pool aggregate is already generating net savings, and we've been very pleased to be able to contribute to that. I think remembering that it's the constituent underlying authorities that lie at the heart of it, we know that their liability profiles will change. Pensioners, scheme members do not stand still. So I think the challenge, particularly on alternatives or illiquid assets, is one where most of the appetite or the developing appetite for the constituent authorities will be within their asset allocation. And I think there arguably is the greatest prize. The government had its own reasons for wanting to highlight infrastructure, but in a sense it was highlighting the way forward for a lot of LGPS assets. And I think getting into that, being able to develop solutions that meet the authorities' needs, I think has the potential to generate the most savings. So I think that's a real prize for us over that timescale.
Kevin, thank you very much. And the final comment of our discussion today goes to the person who actually gave us our first comment, Laura.
Back again. So in the next 6 months, we need to launch our fixed income funds. After that, we're more or less done. So we're already turning our attention to the future and what that looks like. And we're thinking about at the moment how to innovate in this current environment, because we are looking alongside our partner funds to move the portfolios towards that net zero journey. What does that look like? How do we innovate with what we've got with our managers to really build on that? And it's going to be different in a culture where we're mostly remote, I think. So we're starting to turn our attention towards business as usual, but more towards collaboration with our managers, with our partner funds, with our shareholders, to build out for the future now. So we've got the bedrock there and done almost. So it really is about planning into the new world that we're living in and we're going to be living in, because I think as we alluded to earlier, the pace is fast actually, and there's not going to be any let up. Even though we're working remotely, nothing changes. And if anything, actually it speeds up a bit.
Laura, is actually a very good point to end on. I'd like to thank each and every one of you for your time today. It's been a fascinating conversation, and I'm sure that as you guys continue, we'll be keeping tabs on you and we'll be speaking again. So thank you very much, and I hope you stay safe. Thanks, guys.
Thank you.
Thank
Bye-bye.
you.
See you all.
Bye.
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 Bye.